Hello, everybody. Welcome back to Austin, Texas. It's a gorgeous day here, as usual. I have a really good talk for you guys today. The title of my talk is Inconvenient Truths of Option Strategy ETFs. Subtitle is Covered Calls Are Trash in Bull Markets. Now, the reason I did this one is because the other night I was speaking with Kamir on the live stream, and we spoke a long time. And at one point, I was telling everyone the way these funds blow up, or the way these funds, not blow up's the wrong word, but the way these funds become less attractive and people stop talking about them as much, is when we go into a runaway bull market. And I think that a lot of people didn't understand that, and frankly, I did not do a good job explaining it. So I wanted to make a talk and try to elaborate on it and see if I can't tidy up some of the stuff I said. But you have to look at opportunity cost. So in a runaway bull market, it's not like these funds don't still collect an option, a premium. They do. And it's not like they don't capture some of the upside when the market's blowing up all the time. They do, of course, but they underperform the worst in a bull market on a comparative basis. Like I always say, if you're hanging out at the country club or hanging out at church and you're talking about the market with your friends, and other people have just the QQQ, not the QQQYs, well, they're all bragging about being up 40 and 50%, in a runaway bull market. And you're going to have to kind of be quiet and shrink into the background because you're underperforming by a bunch. And people don't realize it. These are actually made for sideways markets and for bear markets, in my opinion. A lot of people don't think so, but in my opinion. All right, so we got to look at the macroeconomic factors that contribute to a bull market. So I made a list of some of the ones that I could think of off the top of my head. The number one factor I would say is interest rates. That's both an indirect and a direct factor, and I'll explain why in a second. But the second one, and it's related to the first one, is Fed policy. Free money, the free money policy that you get whenever you have a very good business climate, and that usually leads to a bull market. Then, of course, there's the trend of the market itself. Sometimes the market will trend up in such a way, or interest rates will trend down in such a way that the trend becomes a thing in itself. Then there's also, I made a video the other day about my first option trade and how Donald Trump got me into the options market. But what it really was, in the 80s, there was a bunch of mergers and acquisitions. They call that M&A. And M&A, when you have a bunch of mergers and acquisitions, that can provide a floor under the market, and that can provide a boost to the market. We saw that in the late 80s. We also saw that in the mid-90s again. Well, then there's also the trend of correlated assets, and so I'm talking about real estate, and I'm talking about bonds, and I'm talking about crypto. They can contribute to a bull market also. And then, of course, inflation's a factor in all of this. So in options, there's something called delta, and we talk about delta all the time. This is a 50 delta. That means it's at the money. 50 delta means that if the market goes up $1, the option is going to increase in value by 50 cents. And that's a characteristic of usually at the money options. But delta is a pretty easy one that a lot of people understand. But there's also an input in the option modeling formula called rho. And rho measures the option sensitivity to the change in interest rates. So an increase in interest rates will drive up call premiums, but they will cause put premiums to decrease. So calls have positive rho, while puts have negative rho. Okay, so let's think about calls having negative or having positive rho for a second. That means that calls are going to pay more or going to be more expensive as interest rates go up. So that means if you're running a covered call strategy, the premiums are going to be higher as interest rates increase, and you'll be able to capture more premium. When you sell a covered call, it'll be worth a little bit more than in a time of zero interest rates. The math behind option models may seem, daunting, but the underlying concepts are not that hard to understand. The variables calculate a fair value for the stock option, or the variables calculate a fair value. So the variables you use are the price of the underlying stock, the volatility of the underlying stock, the time till expiration, the amount of dividends that stock pays, and I'm not talking about yield max dividends. I'm talking about real dividends. So just, forget about that for a second. Like Apple pays a pretty nice dividend, I think, a couple percent or something. So that, if you were doing an Apple option model, you would put in whatever their dividend is, their yearly dividend. Like I say, I thought it was 2%. I don't know. But the first three, which is the stock itself, the volatility of the stock itself, and the timed expiration, they're by and large what goes into pricing the stock of an option. They're the price of an option. That's mainly what it is. But the amount of dividends that a company pays and the interest rates do affect it also. And a lot of people forget about it, and they just think of an option as how much days till expiration and how volatile the underlying is. That'll get you part of the way there, but just not all the way there. So the cool thing about dividends and interest rates, they're components of the option pricing model. So they directly contribute. These market makers that are so smart that I'm always talking about, and these computer models that they have, that's part of their inputs is dividend and interest rates. The thing is about it is you kind of double dip with dividends and interest rates because they directly help price the options, but they also indirectly contribute to the price of the options. In other words, when interest rates go down, it creates a bullish environment for stocks. Free money. Silicon Valley loves free money. There's so many businesses that have started in the 2010s that probably would have never started if the money hadn't been totally free. I'm looking at you, Bird Scooter. There's a bunch of them. Bird Scooter is one of the best ones I could think of. But heck, I don't know if Airbnb and Uber would be around if it wasn't for basically 10 years of free money. And that free money adds to the trend of the market and makes the market go up. A lot of people use margin to invest. So, of course, as interest rates go down, margin rates go down. So that's also a factor. So the dividends and interest rates are probably the two most, especially interest rates, are probably two of the most important things that people overlook all the time. The key is stockholders. If you're a stockholder, you get paid if you own stock in Apple, you're going to get the dividend from Apple. But the option holder, if you own a call in Apple, you don't get the dividend. But so that's why the prices of the calls and the puts for that matter, they reflect the dividend that the stock pays. It's built into the price. All right, so now let's talk about VIX. VIX is the 30-day expected volatility or the forward expected volatility of the S&P. And a lot of these funds like the XYLD and the JEPY and the JEPI, they trade the S&P. So VIX is a good thing to look at as a proxy for how much premium a cover call strategy or short put strategy could be bringing in. So we're going to go back and look at history of volatility. So these are weekly bar charts. And the line is right at about 1250 or so. I guess this is 1235. But my point is the line is whenever the VIX gets under that line, you can't see. Hang on here. We're going to look at a live chart of VIX. All right, so I did here. Here's a weekly chart of VIX, and it's overlaid with interest rates. So you can see as interest rates go up, it makes volatility go up, is what I was trying to illustrate. This spike in interest rates or in VIX right here was March 2020, the COVID deal. So that was that. What I wanted to direct your attention to, and what I was talking about the other night, I was talking about runaway bull markets. In a runaway bull market, a couple of characteristics are low interest rates, but another characteristic is low volatility, and the low interest rates cause the low volatility. But you can see whenever you get extended periods of time where it's under this green line, it happened. It happened a bunch from like 16, 17, and even into 18, and in the first part of 18. And it went up, VIX went up a little bit, but then even in the middle part of 18, we got some super low readings. That's called when VIX is compressed or volatility is compressed. Well, guess what? Whenever that happens, covered call strategies and short put strategies, they pay poorly. They don't pay that much. The good news is the asset that you're tracking is going up, so you don't have to worry about as much about the situation that we've had in Tesla lately, where the underlying pulls way back and it causes the yield fund to pull way back too. So you don't have that worry, but you have a different worry. You have the worry of, hey, my high yield fund isn't paying as much as it used to. I made the bold claim that in the future I could see QQQY and JEPY paying half of what they do now, 25, 30%, 20% even, instead of these 60s and 70s and 50s that we've become used to. I also got to give it up to Victoria Media. I was tough on her the other day. She had a bad review on QQQY and made some inaccurate statements. She's not a bad person. She's a great person. It's a decent channel. She had a great review the other day, and I wanted to give her a shout out to it, and she's talking about this same thing. She was telling everyone going forward that SVOL, like going forward to next year, she didn't think SVOL would be as attractive. And she was talking about volatility compression, which is a real thing. So look at this. Here's the current chart. Here's where we're sitting right at this line. If we get into much more of a bull market and the Fed starts lowering rates next year, which people are saying they're going to, next year will start to look like 2017 and 18 and even 19. And guess what? Back then, covered call strategies and short put strategies, the yields were not that good. We have history. We can go back and look at XYLD or XYLD and QYLD, and I'm going to do that in a second, as a matter of fact. But I think that Victoria Media, she sees the writing on the wall like a lot of us do, and she's telling her customers, rightfully so, to reduce their positions in SVOL. I think SVOL's been paying 17, 18% lately. Well, it's been monetizing this high yield, this high VIX right here. You can see 22 was a great year for any of these types of strategies because VIX was, pretty much elevated all year, and that's why these strategies have done so well. Look at what Coney's doing lately, and and QQQY, my Lord, they're just doing great. Okay, but give it up to Victoria. She sees volatility compression coming next year. I can't predict the future, but if it does come, yes, SVOL's not going to be near as attractive. Neither is QQQY, just to be honest. Neither is JEPY. And JEPY is the one I'd be worried about a little more. Let's go up here to the Global X website. They have a good website, a great website. I heard another influencer say that, and boy, I really agree with that. Okay, so what this will show us, they have good records, and QYLD and XYLD, they keep track of the dividends they were able to capture over history versus what they paid out. And I'm not really worried about what they paid out, but I just want to see what they captured. So it's here in the left column. So we look back, I guess it only goes back to 2018, but we look back to 2019. Look at the the XYLD, which tracks the SPX. Look at these. It was only capturing less than not even a percent. That's crazy. These funds are supposed to pay out 1%. They try to pay out 1% and they cap it. But the market for volatility was so poor in 2019, and it was in 2018 and 17 too. The charts just don't go back. We don't have the information back there. But it was so poor for volatility, they couldn't even pay their crappy little 1% dividend or 1% that they pay out. I kind of make fun of it, but anyway, they couldn't even achieve that. They were paying half a dividend. Sometimes in February of 2019, they did not even make enough money to really justify a half dividend payment. But you could see the effects of volatility compression here, and it's particularly pronounced in the S&P. And that is because the S&P on a good day is less volatile by about 50 to 60% than the NASDAQ. And you can see that in these numbers. The NASDAQ was, they were capturing 1.8%, but they were only capturing in the NASDAQ. But the same month, the managers only caught about 0.5% in the SPX. But, even the NASDAQ, they weren't capturing a lot for the NASDAQ, because look here, let's look up here to 2023 or 2022. In a year where the VIX is elevated, like I just showed you on the chart with 2022, these guys are capturing 3% and easily 3%. Look, in June of 2022, 4%. And the S&P managers are back up to capturing the higher percentages too, and they're able to pay 1% again. But what I see, and I'm not necessarily saying it's coming next year, but it will come sometime, when we have a runaway bull market again, and it will happen, volatility will get super compressed. Investments like SVOL, investments like QQQY and JEPY won't be near as attractive. Now, I'm not saying sell them, or I'm not saying it to worry anybody. They still have a place in the portfolio, because guess what? What also happens in the runaway bull market is interest rates go down. So if you have any bond funds or a CD or any type of fixed, any type of whatever that's called, fixed, I'll put it up on the screen. If you have any of those types of investments, yeah, you're going to be paying a lot less. So there's still a place for dividends, because you can capturing 1% a month, which is 12% a year. That's still pretty good, and it's still better than interest rates are going to be paying you in a runaway bull market. Okay, I'm going to get back here to my slides and see if we missed anything. All right. Okay, we talked about Global X and what a great website they had. Oh yeah, I was also going to remind everyone, don't forget to check out my merch. It makes a great Christmas gift for the dividend investor in your life. I really appreciate you guys. You've been super supportive of the channel, and it means a lot to me. I designed some socks, and you can see them. It has my branding. And, I even got a refrigerator magnet. I kind of like this. I kind of like this. This one's my favorite. It says, all dividend investors go to heaven. That's a really nice one. I like this one too. It says, dividend investors make the best lovers. Anyway, consider that, and thank you for tuning into this video. It was a little bit in the weeds. Kamir accused me of using big words the other night, and I do, but I don't mean to necessarily. When you talk about options, you almost have to. So please send me a comment if you have questions about volatility compression, or questions about how a runaway bull market affects the pricing of covered calls and covered call strategies. Thank you so much, and you guys have an awesome afternoon.